This week, we're going to be talking about securities markets, and we're actually going to be covering three separate topics. First, we're going to take a look at how stocks or other types of investments trade in the market, and how the way they trade actually will generate some transaction costs. Those transaction costs are important for investors because they worsen the performance of a particular trading or investment strategy. And we'll show you actually how to directly measure the transaction costs. Next, we're going to be talking about two types of trades. The first is margin or purchasing on margin. And purchasing on margin is where I borrow money, I take the money, I buy stock. I'll also talk about a last type of trade. That is where I'm going to borrow stock, sell the stock, get cash after I sell the stock, and with the intention of later buying back the stock. And we'll talk about where both types of trades make sense for investors. In addition, we're going to be coming back to margin and short selling throughout the course. In the context of modern finance theory, they're important tools that allow investors to control the risk of a particular investment strategy. And we'll be, again, coming back to this topic in later lectures. So let's take a look at how securities trade, and specifically what we're going to be doing is looking at several different types of orders. When an investor wants to buy or sell a stock, they're going to place an order. And if I just want to get into the position immediately, I might place a market order. So for example, let's say I want to buy Intel and I place a market order. I'm going to accept whatever the best prevailing price in the market is. So let's say I want to buy 100 shares of Intel. And if you recall from the previous video, when I buy, I pay the ask. And in this case, I'm going to be paying $15.96 to buy the shares. Also, if I wanted to sell Intel, again, the 100 shares, I would receive $15.95. Now, I may also want to place in what's referred to as a limit order. And a limit order is an order to buy or sell if the price is at a particular level or better. For example, let's take a look at a limit buy order. With a limit buy order, I'm only going to buy the shares if the seller is willing to accept $15.91 or lower. So if they're not willing to sell at that price, then I'm not interested in doing the transaction. In addition, we could place a limit sell order at, so that's going to be at $16.01, and I'm only going to sell if the buyer is willing to pay you $16.01 or better. And so let's take a look at a few more types of orders. The first is a stop loss order, and the stop loss order becomes a market sell order when a particular trigger price is encountered. What does this mean? Let's say that I bought Intel at $40 a share, and I put a stop loss order at $38. So if Intel's stock price drops down to $38, then that order becomes a market sell, and I'll take the best available price for the shares that I have that I want to sell. So you can think of a stop loss order as limiting losses when I purchased stock. Now the second type of order is a stop buy order. And a stop buy order becomes an order to buy when the stock price moves up to a particular level. Now, this is often used in conjunction with a short sell. And we'll be talking about a short sell later on in this lecture. So for now, I just want to explain the mechanics of a stop buy order. So I bought Intel again, I've short sold Intel at $40. And I put a stop buy order in at $42. So if the stock price goes up to $42, then that becomes a market buy, and I buy the number of shares that I put in the order for at the best available price. A couple of other types of trades. A discretionary order is where I allow a broker to buy or sell on my behalf, and it's often used by investment advisors for some types of clients that want to give discretion or power to trade to the investment advisor. And the last type of order, the last thing I want to talk about is the time dimension of an order. So when I place an order in, there are different ways that I can specify how much time my order will be outstanding. I could do an immediate or cancel order so that I place the order in, and then if it's not immediately filled, then that order is canceled. I could do an order which is good until the end of the day. So I place the order in the morning, and then a limit order in at the morning, and then at the end of the day, if that order hasn't been filled, then it's canceled. And then the last one is good until canceled, and that will allow that position to remain open over a number of days. So for example, I might say, well, I'm willing to wait up to 60 days in order for this order to be filled.